Which stock gives you better income? This one with a 4% dividend yield, this one with an 8% dividend yield, or this one with a 5% yield? Most beginners want to point at the biggest number. 8% sounds better than 4%, but dividend yield has a trap. The yield number does not tell you why it is high, and that why is the whole lesson. Start with one share. The market gives that share a price tag. In this simple example, the share costs $100. Now imagine the company pays $4 of cash dividends over a year. Dividend yield compares those two things. Annual dividend per share on top, share price on the bottom. $4 divided by $100 equals 4%. That is dividend yield. It is the cash payment compared with the price you would pay for the share. The clean formula is dividend yield equals annual dividend per share divided by share price. The unit match matters. Use dividend per share with share price, or use total dividends with total market value. Do not mix one share with the whole company. For beginners, the per share version is usually easiest. $4 per share divided by $100 per share equals 4%. The dollars cancel. What remains is a percentage. Now comes the aha moment. Keep the dividend exactly the same. The company still pays $4 per share, but the stock price falls from $100 to $50. The yield doubles. 4 divided by 50 equals 8%. Nothing about the cash payment improved. The yield rose because the price fell. So a higher dividend yield can mean you're getting more cash for each dollar invested, Gaux, or it can mean the market is worried, so the price dropped. Those are completely different stories. Now, there's a healthier way for yield to rise. Keep the price at $100. Now, the annual dividend increases from $4 to $5. 5 divided by 100 equals 5%. This time the yield rose because the cash payment went up. So when you see a high yield, do not ask only, how big is the number? Ask, did the dividend rise or did the stock price fall? That one question prevents a lot of beginner mistakes. Here is the high yield trap. A stock used to trade at $100 and pay $4 per year. The yield was 4%, then the price falls to $33. The website now shows a yield near 12%. That can look amazing, but the website is only doing snapshot math. It is taking a dividend number and comparing it with today's stock price. It is not promising that the dividend will keep getting paid. Sometimes the price falls because investors think the dividend is in danger. The big yield can be a warning sign, not a gift. So when a website shows a huge dividend yield, read it as a clue, not a contract. To judge a dividend, look behind the payment. The company needs cash coming in. Then it chooses how much cash to send out to shareholders. If the business can comfortably refill the bucket, the dividend may be easier to sustain. If the dividend pipe drains the bucket faster than the business refills it, the payment becomes fragile. That is why a 3% yield can be safer than a 10% yield. The 10% number may look larger. But if the cash support is weak, the payment may be cut. Yield tells you the size of the payment compared with price. It doesn't tell you whether the company can afford the payment. Watch what happens if the dividend gets cut. At $33 per share, a $4 dividend shows about a 12% yield. But if the company cuts the dividend to $1, the new yield is only about 3%. The big number disappeared. And the investor who bought for income is now receiving much less cash. There is another problem. If the stock price fell before the cut, the dividend may not make up for that price loss. Getting income is useful. But income does not erase a falling stock price. This is why high yield is not automatically cheap. High yield is a question. Can this payment survive? One more beginner trap. A dividend is not magic money from nowhere. When a company pays a dividend, cash leaves the company and goes to shareholders. That can be good. It can reward owners. It can show that the business produces more cash than it needs, but it also means the company has less cash inside the business after the payment. So dividend yield is only one piece of the picture. You still care about the business, the debt, the growth, and whether the cash keeps coming. Also notice what the website usually shows. It shows yield using the current stock price. If you bought years ago at a different price, your personal income yield on your original cost may be different. That can be interesting for you, but for comparing stocks today, the current yield is the clean starting point. Now go back to the opening question. Which yield is better? The answer is not automatically the highest one. A steady 4% yield with strong cash support may be useful. An 8% yield created by a collapsing stock price may be dangerous. A 5% yield created by a growing dividend may be attractive if the business can afford it. Same metric, different story. The number is the starting point. The path behind the number is the lesson. That is the real comparison, not just yield versus yield, but yield plus the path that created it. Here are the beginner mistakes to avoid. Mistake 1, the highest yield is the best. Better question, why is the yield high? Mistake 2, dividend yield is guaranteed income. Better question, can the company keep paying it? Mistake 3, a dividend stock cannot lose money. Better question, what happens if the stock price falls more than the dividend pays? Mistake 4, a website yield is a promise. Better question, is this a durable payment or only a current snapshot? Mistake 5, yield alone tells me what to buy. Better question, how strong is the business behind the payment? Here is the final rule. Dividend yield is annual dividend per share divided by share price. It tells you the cash payment compared with the price of the stock. But a high yield can come from two very different paths. The dividend went up or the price went down. So never stop at the yield number. Ask, why is the yield high? Can the business support the cash payment? And what happens if the dividend is cut? Dividend yield is not the answer. It is the first income question. This is education only, not financial advice. Next, we need the survival test, payout ratio.